So I want to talk to you about emerging markets. Yes, I have not talked about them in a while. I want to talk about them from an equity point of view and a bond point of view, and talk to you what I think is really going on with this entire sector slice segment and why I believe you should stay away from it until this one thing happens. And once that one thing happens, I think it could be a really good place to make up for lost time and really see a pretty fierce rally. But this one thing has to happen. So let's get to that and see if there's anything else we can dig into. All right, see you there. All right, everybody, this is RC Peck, and this is my weekly update. And I want to talk about emerging market stocks and bonds. I don't think anyone's really talked about them later. Everything's been on either inflation or gasoline or commodities or the stock market rallying. And is the rally over? Is it not a rally? Is it a bull rally? Is it a bear rally? Let's just take our attention away from that just this week and look at emerging markets. So here on the screen, I have EEM. It's a pretty big ETF. It's the largest ETF around for emerging markets. And from its peak in 2021, it actually had a pretty respectable fall of 32%. Now, the NASDAQ fell about 33%. The thing is, from the pre-COVID high, just notice emerging markets only went up about 27%. Now, for reference, let's just use the Qs for reference. From the pre-COVID high, the NASDAQ 100 went up 72%. So not quite 3 times the amount, but pretty darn close. So yes, emerging markets did break above and move up a total of 27% from pre-COVID. But they reversed all that and then some, right? They have fallen about 32, 33%. Now, what I noticed first is it's below pre-COVID high. That's not a good sign for the strength of any equity or any bond. And an entire slice of the planet is not doing well. You can go look up on ETF database exactly what the allocation is to EEM. But this is not looking good. It is below its pre-COVID high, and it's kind of in this, am I allowed to say no man's land anymore, or is it no person's land? It's just this area of it's not this and it's not that. Now, yes, buying has come in down here slightly, but you really got to see emerging markets get back up on its feet. Now, if I was to take EEM and just divide it by the S&P 500, you'd see that, wow, it is really weak looking. It is really weak looking. In fact, it's made a new low. So let's zoom out here a little bit. Let me just go out 20 years. It's at a 20-year low. Emerging market stocks. Now, EEM, this has dividends reinvested. I'm dividing it by the S&P 500 SPY with dividends reinvested. It has just made a new 20 and a half year low. Emerging markets stopped going up relative to the S&P in 2010. This part of the world has not seen a break. There's been a few points where it has broken above. I'm looking at this right here where it did break up again. It did break above some resistance, and it did have a nice break above here too. But then it got pulled right back into kind of this downtrend. If we then were to take EEM and divide it by all world ex-US. Actually, let me just do all world ex-US, the MS world, because we can go back farther with this. So now look at the price chart. This is emerging market priced in international. So if you basically are in the US, MS world is international. What it really is all world ex-US. And so in this case, you can see that emerging markets really could not, because they were doing well. I mean, look at this. They were doing well up until the end of 2010. And then when they were compared to the rest of the all world ex-US, that's MS world, just kind of flat to sideways. Now, probably the bigger news is really just stay away from international altogether. Here's just MS world's the all world ex-US, and you can just look at it right there. Oops, I forgot to put in a $, MS world. If you look at MS World here, it's had a double top. Now there's no dividends reinvested here, and this is in local currency. So that is an incredible double top, because the first top here is the global financial crisis. And then as you can see, here's the next one right there. It really wanted to break out, and it didn't. And so it's just back into this messiness. So really all international has been a place that you really, really wanted to have avoided. If I just take MS World and I price it in S&P units, you can see the exact same thing. Now, international emerging markets stopped going up right about here. But if you see here, this is MS World stopped going up against the S&P 500 actually about 2 years before that. MS World, let's just keep it really equal here, SPX. So let me just take the dividend out. So international has been a place to avoid really since October 07. I mean, this is another new 20.5-year low. Now, I said I was going to talk about emerging markets, and I have. But I also want to point out it's not just emerging markets. It's all international that you really want to stay away from right now. The price chart you're looking at is the all-world ex-US priced in SPX, so S&P 500 index units, and it has been falling since 2007. We'll call that 15 years. That's not good. Okay, let's see. I wanted to also show you emerging market bonds. So here's emerging market bonds here. EMB. Now, I don't have this back, at least on stock charts. It only goes back to 08. And you can kind of see, or at least what I see first is that. I see kind of a foundation, kind of where buyers come in down there. It stopped falling at that price in the COVID crash. It stopped falling here. But this is really, again, the bonds aren't doing well. The stocks aren't doing well. And the reason is, let's do this. Let's just look at the US dollar. The US dollar, and there's been a big reason for it, at least lately, though, if you remember, I said right around here is when international was really the place that stopped outperforming against the S&P. And the dollar stopped falling just a little bit after that. And yes, it's been very kind of volatile in a sideways, but generally speaking, it's actually been going higher over time. What is really interesting is the dollar is now above 104. So this is USD. So this is the index, the dollar index, and it broke and stayed above 104. That is putting huge pressure on emerging market debt and emerging market stocks. I don't really see how they get back up off the floor. I don't even want to say until the dollar weakens again, because if I zoom out a little bit more on the dollar, let's go out to 30 years. Your brain can immediately see that the dollar could go up here, right? It was there during the dot-com crash. The dot-com crash basically started in March, kind of there between those two blue lines. Can you see those? You can't really see those two blue lines that well, can you? Sometimes it's hard to see on the screen. But basically during the dot-com crash, the dollar really spiked. So the dollar has not really settled down yet. So that would definitely be a concern for stock bulls, that it's still moving up. But again, the kind of the thing I'm focusing on here is emerging markets. Now here's EEM super zoomed out. I only have EEM here back to about 1995. Now this is with dividends reinvested. So you can see it's at that point. So this is a positive for emerging markets. It's back down to where it hasn't been able to stay above, right? So EEM with dividends reinvested has had an exceptional difficult time staying above, let's just call it $40. And so there it is, right kind of back at the scene of the crime, right back down to $41. So on the bullish side of EEM is that this resistance, $41 has been a resistance in the past, if EEM can stay above the 40 zone, and it's probably better to just say the 40 zone because it really runs from about $39 to $41. But for the brain, human brain, let's just say $40. If it can stay above that, then that's good news for it. So if you were trading, you really can't be bullish until emerging markets above, or EEM's above $41. But there's a lot of pressure against it. There are a lot of other, not only asset classes, but other price charts working against EEM moving higher. So for now, I would say this is absolutely a skip, especially, again, I'll just go back to the US dollar, especially with the US dollar breaking above that, right? So it broke above, I called it 104, and it is staying above it. It could absolutely move up to about 120 or 122-ish, which is where it hit in .com. So if things are going to really calm down, and in fact, the correction's over, the S&P fell about 23%, the NASDAQ fell about 33%, EEM fell about 33% too. We'll want to see the dollar coming down and really come down back into this zone. That's what we're going to want to see. That will help us believe that, in fact, the stock market fall that started literally at the beginning of the year is over. Okay. So let's do this. Let's just kind of wrap this up. So we have been taught, in fact, it even says on Vanguard's website that you want to have 40%, 40% of your money in international equity, right? So if you have 80% of your money in stocks, they want 40% of that 80% to be in stocks, which would be an absolute 32% or a third of your money. And that has been a ginormous drag on people's portfolios over the last 10 to 15 years. It has not made them safer. It has not gotten them to retirement earlier. It has not kept them in retirement. And I call this over diversification, and it is very, very expensive. It actually increases your angst and anxiety and worry and overwhelm, and it doesn't lower anything. It's truly people just being over diversified. And if you own emerging markets, and you have owned emerging markets, and if you have owned international, whatever symbols they are, whether they're individual companies or ETFs, it's literally been a tax. It's been a diversification tax, an over diversification tax on your portfolio. So let me know where you think I got it right, where I got it wrong. Leave a comment. If you're curious if there's a better way to manage your money, have your money grow, please just hit the link in the description and I will do a deep dive on your portfolio, like a portfolio review, and show you exactly where you're leaking money. As crazy as it sounds, it's usually 3 to 5% a year. Everyone's so focused on that 1% management fee, and then kind of right over in the corner, there's this massive, really tax or unnecessarily slower growth of 300 to 500% more expensive than that 1% fee. That's what we find. Over diversification is literally costing people 3 to 5% a year. That's a huge number. Thanks, guys, for being in my world. I appreciate you doing that. Of course, leave a like if that's something you do. Leave a comment, same thing. And I will speak to you on the next video. Okay, bye.